Welcome back. My name is Jonah Beecroft. In this section, you will learn the double entry system of accounting. Get ready with your writing material. Let's dive into the fascinating world of double entry accounting. Life is full of pairs. Good and bad. Yes or no. Yes and no. Hot and cold. Day and night. Positive and negative. Man and woman. Man and woman. Each side depends on the other to succeed. Each side of the pair depends on the other to succeed. This same idea drives the double entry accounting. This same idea of duality drives the double entry accounting. Every transaction has two sides, a debit and a credit. Yes, every transaction has two sides, a debit and a credit. One gives and the other receives. One gives and the other receives. This duality kept records balanced and accurate. In this section, you will learn the basics of double entry accounting. And how double entry accounting works. Let's get set. Now, the accounting equation, which is assets plus is equals to liability plus equity, can be further expanded as asset plus expenditure plus purchase plus drawing is equals to what? Liability plus equity plus revenue item. That is A plus E plus P plus D plus L is equal to L plus E plus what? R. Yes, this is the expansion form of the accounting equation. A is equals to what? Assets. E is equals to what? Expenditure. P is equals to what? Purchases. D is equals to what? Drawing. And L is equals to what? Revenue item. This expansion is done for the purpose of proper understanding of the double entry what? System. L is equals to liability. E is equals to equity. And R is equals to revenue items. In our previous tutorial, we have explained asset and its components, liability and its components, equity and its components. In this section, we are going to take a critical study of expenses, purchases, drawing, loss item, and revenue items. We are going to know what they are and their examples. For there's nothing written in accounting from the beginning to when you become a professional that will not be grouped under this expanded accounting equation. Now, we take a look at what expenses. Expenses are costs incurred in the process of earning what? Revenue. The costs incurred in the process of earning revenue. Simple, that is expenses. The costs incurred in the process of earning what? Revenue. Let's take example of expenses. Take a few of them. Rent expenses, utility bills, salary and wages, advertising expenses, office supply expenses, and depreciation expenses, and etc. These are few examples of expenses. Now, purchase. Purchase is the acquisition of goods or services for the purpose of reselling them. The acquisition of goods or services for the purpose of what? Reselling them, or for resale, or for the purpose of these goods and services being used in the operation of the business. The acquisition of goods or services for resale or for use in the business what? Operation. That is purchase. Examples of purchase. Example of purchases. You can purchase purchases of the following: purchases of raw materials, office equipment, inventory, furniture, tools, and software, etc. This purchasing definition will change slightly when we want to define it in terms of profit and loss accounts. But we are defining it here in terms of the accounting equation. Drawing. Drawing, the withdrawal of funds or assets from the business by the owner of the business for personal use. The withdrawal of fund or asset from the business by the owner of the business for personal use. Underline that personal use. It's not for the business use, personal use. Because the business is a separate entity from ownership, according to the business entity consent. Example of drawing as follows: cash drawing, inventory drawing, office equipment, office supply, equipment, withdrawal from the business by the owner of the business for personal use. The attempt drawings, withdrawals of cash, fund, asset, and whatever it is from the business by the owner of the business is referred to as what? Drawing. Lost items. These are expenses or losses that reduces the overall profit of the business. Expenses or losses that reduces the overall profit of what? The business. Example of lost items are losses resulting from sales of what? Assets. Resulting from bad debt written off, or theft or fraud resulting from natural disasters, and inventory written down. Loss resulting from lawsuits and foreign exchange fluctuations. These are what? Loss items. They are loss items. Now we take a look at revenue items. What are revenue items? Have you heard it before? Revenue items. Revenue items are profit items. Revenue or income generated from the primary activity of the business. Income or revenue generated from the primary activity of the business. That is, all these income generated from the primary activity of the business are all revenue what? Items. Example, you have sales revenue from sales, service revenue for service rendered, and you have interest on bank deposits. Then you have commissions. There are some things the business will do and they get commission. And also, the least and not the last, dividend from investments. All these are revenue what? Items. All these are revenue what? Items. Having known that, now we are going to take a critical examination of the left-hand side of the expanded accounting equation, which is asset plus expenditure plus drawing plus purchases plus revenue items. We are going to take a holistic examination of this part of the expanded accounting equation. What we need to know here is how these components increase and how they decrease. This component of accounting equation, assets, expenditure, purchases, drawing, and loss item, reduce in the same side and they increase in the same side. they give and they receive in the same side and give out at the same side. So they behave the same way in terms of increase and decrease, and they take their balances in the same way. Now, this set of the component of the expanded equation increases by the debit side. I put plus there to indicate increase. They increase by the debit side. That is, they receive value by the debit side. That also means that they increase by the debit side. And they take their balances, if any, by the debit side. That is, they increase by the debit side, they receive at the debit side, and they take their balances, if there is any balance at all, by the debit side. Or this component behave in the same way. And they reduce by the credit side. That is, that negative negative sign indicate they reduce by the credit side. They give by the credit side. They reduce by the credit side, and they give by the credit side. We shall be taking a look at the receiving account and the giving account. That is the bane of the accounting word equation. The receiving account and the giving word account. So it is correct to say that this group of the component of accounting equation received by the debit side and give by what? The credit side. And that is the first golden rule. Debit the receiving account and credit the giving account. Or another way, debit the receiver and credit the giver. This is the first golden rule, and it is true for all the expanded accounting equation component as stated above. So, the first golden rule says debit the receiving account, credit the giving account. This is what? The first golden rule. That means when asset increase, it increases at the debit side. When expenditure increase, it increases at the debit side. Purchases increase is at the debit side. Drawing increase is at the debit side. And losses item, when they increase at the debit side. And vice versa. When assets decrease, they decrease by the debit side. When they give by the debit side. Expenditure, when they decrease, debit side. Purchases, when they decrease, debit side. Drawing, when they decrease, debit side. Loss item, when they decrease, debit side. That is the bane of the first golden rule. Debit the receiving accounts, credit the giving accounts. For all transactions must be double. One is the receiving account and the other is the giving account. There will be no receiver if there is no giver. Before a transaction is complete, there must be a willing giver and a willing receiver. Let's glance at the other side of the the expanded accounting equation components. That is liability, equity, and revenue items. Now, this set of this set of the component of the expanded accounting equation also behave in the opposite direction. Liability increases by the credit side. Equity increases by the debit side. And revenue item increases by the debit side. Liability increases by the credit side. Equity increases by the debit side. And revenue item increases by the debit side. When liability reduces, it reduces by the debit side. When equity reduces, it reduces by the debit side. And when revenue item reduces, it reduces by the debit side. That means we are right to say credit the receiving account and debit the given account. In this set of the expanded accounting equation, it is true at all times. This will lead us to the second golden rule, because we have only two golden rules in accounting. Credit the receiving account and debit the given account. When liability receive, you credit it. When equity receive, you credit it. And when revenue item receive, you credit it. For that is bring us to the second golden rule. Credit the receiving accounts, debit the given accounts. This is the second golden rule. There's nothing you are going to know, no account, no record that you are going to record in accounting from the beginning now that you are a learner to when you become a professional accountant that will not fall into this component of accounting equation. For that, there are only two golden rules. The golden rule for the set of accounting in the left equation from the left hand side, and the set of accounting in the right hand side, which is this: debit the receiver and credit the giver in the other side of the accounts. In this one, credit the receiving account and debit the given account. These are the only two golden rules, and these two golden rules will build your foundation in whatever you are going to do in accounting profession. From now to when you're chartered, to when you obtain your master's and doctorate degree, this is the basics of what accounting, and that is how the double entry accounting works. Now let us go into full practice. Let us do it practical to bring out the essence of double entry. This example 1, plant and machinery was acquired for 200,000 through the bank. The first thing we will do, there must, in any transaction, there must be two accounts, at least two accounts. The first one is plant and machinery, and the second one is what? Bank accounts. Plant and machinery is an asset. Bank account is an asset. Bank account give, plant and machinery receive. So plant and machinery account receive. And how do asset receive? Asset receive by the debit side. And the bank give out by the credit side. So this transaction, we are going to debit plant and machinery accounts and credit bank accounts. Now we are going to turn it and see the dual effect of this singular transaction. Plant and machinery accounts receive, so we have to debit it. Bank 200,000. That is all. And for the purpose of balancing it, we carry it down to the other side, to the credit side. Balance carried down. That is balance carried down is saying 200,000. And we rule off. We rule off. Rule off. Rule off. Rule off. We rule off by ruling off with double stroke. And I said, take their balances by the debit side. So you now bring it, balance brought down is equals to what? 200,000. So anybody, any accountant that see this table will know that the balance of plant and machinery is 200,000. By looking at what? The balance brought down. The balance brought down is what an accountant looks for. That is the balance of plant and machinery. Now we go to the bank account. The bank account gives. And which side did bank account give? Bank account give her by the credit side. What did he give it for? He gave out that money for plant and machinery. And now what you need to do is to, for the purpose of balancing, you carry down the same 200,000. To the other side, I say balance carry down 200,000. And you do what? You rule off. You rule off. Now, this means all transaction must be double. All transactions must be double. That is double entry. One account gives and the other what? Receive. Bank account give out value and plant and machinery account receive. There is the giving account and there must be a receiving account for a complete what? Transaction. If there is a giving account and there's no willing receiver, then there will be no what? Transaction. This is the origin of the double entry bookkeeping. There must be a receiver and there must be a willing giver. The origin of double entry bookkeeping. There must be a giver and there must be a willing what? Receiver before a transaction is said to have been what? Complete. Double entry accounting. That is what we are treating. So that what we did here is that we debit plant and machinery account and we credit bank account because bank give out the value and the account of plant and machinery receive the value. Now, this is example 2. Example 2 says, Mr. Treeford transferred land and building. That is transferred land and building worth 1 million. Mr. Treeford transferred land and building worth 1 million. Okay, worth 500,000 to his business. He transfer land and building worth 500,000 to his business, and the name of his business is Firebrand Tutorial. Now, what are the two accounts that are involved? The first step is to identify the two accounts involved. The account that involved is land and building. That is one. Which other account? Is it Mr. Treeford account or Firebrand Tutorial account? No, it is not Mr. Treeford account. It is Firebrand Tutorial capital account, because by the business entity concept, ownership is separate from the business. So we are going to debit land and building account because it's receiving. Receiving, and Firebrand Tutorial capital receive. In this account, land and building receive, and the capital of Firebrand Tutorial also receive. That means there is increase in assets and there is increase in what? Equity, which is what? Capital. So land and building account will be debited, while capital account will be credited. That is the way they receive their increase. Asset increased by the debit side, while equity increased by what? The credit side. That is what? The double entry. Business is separate from ownership. That is why we are not going to say it is Mr. Threefold what account. We don't have anything to do with Mr. Threefold. What we have business with is Prior Brand Tutorial, and it is what? Capital of Firebrand World Tutorial. Now let us take the T account. Let us practicalize the double entry with the T account. This is debit and this is credit. And this one is what? At the land and building what? Account. It increases by 500,000. So, just say threefold. Mr. Threefold. 500,000. Transfer it. Land worth 500,000 to the business. And for the purpose of balancing, we carry it down 500,000 and we rule off. And do not forget that asset account take their balances by the debit side. After we rule off, we bring down the balances. Balance brought down. That is the balance, the actual balance of the land and building is 500,000. Any account looking at this table, looking at this T account, we look at the balance carried down. May not pay attention to other things, but the balance carried down, unless for the purpose of audit, you start to find out how you arrive at this balance carried down. The real value is the value that says balance carried down, and it's in the debit side because land and building is asset, and assets take their balances by the debit side. Now, the capital account increases by the debit side. In this transaction, capital increases, and from what? Threefold. So we credit it threefold. 500,000, and we carry it down in the opposite side 500,000, and we rule off and still bring out a balance because equity or capital take their balances by the credit side. Balance brought down now is equals to what? 500,000. For any transaction to take place, there must be a giver and a receiver. This is another example. The same Mr. Threefold. Mr. Threefold purchased goods worth 1 million naira on account from Mr. Smith. Now, when you hear that somebody purchased good on account, it means that the good is purchased on credit. He did not pay for the goods. He will pay for the good in a later day. Mr. Threefold purchased good worth 1 million on account. The two accounts involved must be first of all be identified, which is what the purchases account and what Mr. Smith account. Mr. Smith in this case is what? A creditor. This is what? Liability. Creditors are what? Liability. So we are going to open purchases account and a creditor account. In this case, Mr. Smith. So we are debiting purchases account because purchases received, and the account that gave out is what? Smith, and we are crediting Smith because it is a liability account. Debit and credit, the double entry word accounting. Now purchases account, purchases on the left hand side of the expanded accounting equation increases by the debit side. So put debit and credit and rule it in form of the T account. Debit, credit. Mr. Smith. You purchase from Mr. Smith 100,000. That is what the purchases account. And you bring it down for the purpose of balancing to be 100,000. And you rule off. Purchase account take their balances according to the expanded accounting equation by the debit side. And so balance brought down must be by what? The debit side. Balance brought down now is 100,000. And that is what the purchases what accounts. Now we take a look at Mr. Smith account, which is a liability account, because Mr. Smith is a creditor to the business. Now, liability increase or liability take in through the credit side. So, it's going to be 3/4 make purchase of 100,000, and you bring the balance to the other side for the purpose of balancing. Balance carried down. No, that is a mistake. That one there is balance carried down, not balance brought down. Balance carried down, not balance brought down. That one in the debit side should be what? Balance carried down. Then it is on the credit side that will have balance brought down. That is what human error. Correct it. And that is what Mr. Smith account. It is a liability account. Any accountant looking at this T account will know that they are owing Mr. Smith 100,000. The fourth example reads, Don Roger received 10,000 naira cash as salary for his tutorial work job. Don Roger, he received 10,000 naira cash as salary for his tutorial work job. Two accounts have been involved. The cash account is there and the salary account is there. We first of all identify the two accounts that is involved. Then we ask this question: which account give and which account receive? And what are the classes of the account? Are the both account asset account? Are the both account in the left hand side of the expanded accounting equation? How do salary account receive and how do cash account give? Salary account is an expenses. It received by the debit side. Cash account is an asset. It's given by the credit side. Is that clear? Any question? Any doubt? Now let us open the accounts. Salary account is an expenses account and it receive, so it has to be in the debit side. So we say it receive cash. So what we are going to do is to debit salary account and credit cash. Debit salary account and credit cash. So let's open the T account to explain the double entry. Now we open an account for salary, which are expenses. What did he receive? Did he receive check? No, he received cash. It is cash he received. So salary By the debit side, say cash is what? 10,000. And you are done with this. You can rule off here. But for the purpose of balancing, carry down 10,000. You rule off. Rule off. You may decide to bring the balance down. You may decide to leave it like that. But it's always balanced to bring the balance down. Then the next one is the cash account. The cash account is an asset account. And assets give by the credit side. Reduced by the credit side. Don Roger or salary is what? 10,000. You balance off. You bring the balance for the purpose of balancing off to the other side. Balance carried down is equals to what? 10,000. Yeah, you rule off, and that is all. Any question? If there's any challenge, you can hit the comment section and will not hesitate to respond to you. Now, this is example 5. The same Don Roger. Don Roger purchases goods worth $5,000 on account from Mr. Brown. Yes. Purchases on account is purchases on credit. The two accounts that is involved must first of all be identified. The two accounts is what? Purchases account and Mr. Brown account. In this case, Mr. Brown account is a liability account. So, purchases, what we do here, according to what we have been taught from the beginning, is to debit purchases account and credit what? Mr. Smith account, which is what? A liability account. The creditor. So let us first of all open the purchases account. Goods. What? 5,000 naira. Carry down 5,000 naira. We now, yes, we purchase goods. We balance off. We rule off. Then the balance brought down 5,000. Mr. Smith account, which is a liability account, will Don Roger or goods worth 5,000 naira. And balance brought down also, and you rule off. Then liability account take their balances, if any, from what? The credit side, and that is all. Example 6. This will be the last example, and when we finish this example, we call it off. By this example, we must have exploited all area for you to understand how the double entry accounting system works. This question reads, the following information is from the book of Dumbarton, who commenced business on 1st of January 2024. 1. Dumbarton contributed cash of 1 million naira. Motor van worth 50,000 naira. 3. Procure stock value 20,000 naira on account from Obine and paid 5,000. 4. Acquired land for 2 million naira by cash. He acquired land for 2 million naira by cash. Then the fifth transaction there is made cash sales of 450,000. And the sixth transaction is cash of 150,000 naira taken to the bank. The seventh and the last transaction is paid electricity bill, 500 naira cash. You are to identify accounts affected. That is to identify the two accounts affected in each of these transactions. To classify this account into asset and liability and equity, and tell us how this transaction affected assets, affected liability, and affected what equity. So let's begin. Say we are going to make a schedule, a table to show transaction, to identify the two accounts that are involved under the transaction, how this transaction affects assets, how it affects liability, and how it affects equity. Did it reduce assets? Did it reduce liability? Did it reduce equity? That is what we want to know. The first transaction, they say the two accounts that was involved is what? Equity and what? Cash. The first transaction said Dombada contributed 1 million naira cash. So it affects cash and it affects equity. Asset, which is cash, increase. An increase in cash or asset is what? Debited, so we debit cash. Nothing affects liability there. It only affects equity. Equity in this case increase also. And when equity increase, you enter it in the credit side. So we say credit towards equity. Credit toward equity. So asset increase, no effect on liability, equity word increase. That is the first word transaction. Now the second transaction, since we cannot go back to that slide, we write down the second and the third transaction after drawing this table, so that we will see exactly what we are doing without going back to that slide. Transaction, that is where we identify the two accounts that are involved, because each transaction must affect two accounts. Then what is the effect of this transaction on the assets, the liability, and equity? That is just what we are doing. By this, we are grooming you to be familiar with the double entry system of accounting. So, what is the word second and third transaction? We don't want to go back to the other slide, so we will soon write it down here and take them one after the other. We'll take them one after the other. Now let us write the transaction. And the second transaction says Dondaba introduced a motor van worth 30,000 naira. That is the second transaction. Let us also write down the third transaction, so that by the time we want to do our working, will not get to write anything down again. And the third transaction says procured, Don Daba procured stocks worth 20,000 naira on account. From who? From Mr. Brown. He procured stock worth 20,000 naira on account from Mr. Brown. Yes. So, Mr. Brown is what? A creditor. And creditor are liability accounts from Mr. Obini. Okay, credit from Mr. Obini. It not only buy it on credit, he paid 5,000 cash. He bought it on credit and he paid part of it. He bought it in 20,000 naira and removed cash and paid to Mr. Obini. So what is owing is remaining 15,000. We are going to see how this one imparts on asset, liability, and equity. So let us take the first transaction. The first transaction, the accounting involved is what? Motor van accounts and capital accounts. Yes. Or equity accounts. So there is increase in assets because motor van is an asset. So we put plus there. No effect on liability. And there's increase in what? Equity. So when asset is introduced, the effect is there will be increase in equity. This form part of the objective question. When asset is increased, what is the effect on equity? Equity must increase. The second, the two accounts that are involved are, this one involves three accounts. The stock account, Obines account, and the cash account. It involves cash because cash was paid. Stock account increase, cash account reduces, and Obines account, which is a liability account, increases. So stock account increase, liability account increase. There is no effect on equity because the stock was purchased with cash. Stock increase, then cash what? Reduces. That is the effect. So this transaction affected three accounts: the stock account, the Obines account, and cash account. Every transaction must at least affect two accounts at least. That means it may affect three accounts, as in this case. The next example is the example 4, number 4 of that information, which is acquire land for 2 million naira by cash. Dambada acquire land for 2 million naira paying by cash. And at the same time, he made cash sales of 150,000. Let us see how this thing will affect assets, liability, and equity. The transaction, the first one, that is number 4, he acquired land for 2 million naira by cash. Land account is affected and cash account is affected. That is for a transaction 4. So the two account that is affected is land account and what? Cash account. Transaction 5 made sales of 150,000 naira. The two transactions, okay, let us see what? Cash and what? Land account are the two accounts that have been identified to be what? Affected. Land increases, cash reduces. No effect on liability and no effect on equity, because what they have, cash, already is what they used in purchasing the land. Now the two accounts that are involved in transaction 2 is the sales account and cash account. Cash is asset, so asset increases. No, liability was not affected. It's not affected. What of equity? Did it affect equity? Yes. No, it affects equity, because when there is sales, there is what? Revenue. It's a revenue what? Item. So equity what? Increase. The sixth transaction, cash of 150,000 was taken to the bank by John Bader. And the seventh transaction, John Bader paid electricity bill, paying by cash of what? 500 naira. We shall take them one by one also. Let us draw the table that shows us the identity of the two account that is involved and the effect of this transaction on assets, liability, and equity. Transaction, that is where we identify the two accounts involved. What is the effect of these two accounts? The sixth transaction involve cash and what? Bank accounts. And how does it affect assets? How does it affect liability? And how does this transaction affect what? The equity? Cash did what? Cash was taken to bank. Cash is an asset. Cash is reduced. And bank is increased. This is a contra entry. There's no duality. When nothing affects the liability and nothing affects what? The equity. Then the other transaction paid electricity bill. The two accounts that was involved is cash and electricity bill account. Electricity bill account and expenses account. So expenses account is increased. Electricity account is increased, and cash account what? Decrease. It has no effect on liability and has no effect on equity. On this note, we come to the end of this tutorial. In our next tutorial, we are still looking forward to seeing you. In the course of this tutorial, if there's anything you did not understand, or there is contribution, or you want to criticize, or you want to find out something, please do not hesitate to comment on the comment section. The name of our channel is Jonah Beecroft Obi. And if in any form this tutorial has impacted in you, we appeal to you to like it, share it, so that others who are still looking for such knowledge can benefit. Thank you. Goodbye, and God bless you.